Hi, and welcome to this video tutorial. Today we'll discuss how to conduct a cash flow forecast. We'll also look at establishing a break-even point. Okay, so why is this important? Well, a cash flow forecast looks into the future and predicts what your expenses will be and when those expenses are due. You then forecast how much income you'll make and when payments will come to you. This is hugely important because it gives you an idea of whether you'll have enough cash at any point in time to run your business. Now, the best way to understand this process, in my opinion, is to use a spreadsheet like Excel. I know there are plenty of accounting packages. However, doing your forecasts in Excel actually enables you to understand the basic principles of cash flow. You've been provided with an Excel template in the resources section of the course. Please note there are basic instructions for you to follow at the top of the spreadsheet. These are colour-coded to make it a bit easier for you to understand where to key in figures. The first thing you need to do is type in an opening balance. It really doesn't matter what this number is. We'll be adjusting this later in the forecasting process. You'll see that when you enter an opening balance, the closing balance will automatically adjust to that figure. The number is the same as the opening balance as we haven't added or subtracted any revenue or expenses. You'll also notice that the opening balance in the next month is the same as the closing balance in the previous month. The opening balance will always be the same as the closing balance for the previous month. Once you've completed your cash flow forecast, you'll be able to see whether you'll have enough cash to run your business over the next 6 to 12 months. Now, in order to make the forecasts, you'll need to enter projections for coming months. To start entering forecasts, select the January tab, and this will take you to a new sheet in Excel. For each of the months, you'll be able to forecast what you're likely to spend and what you're likely to make. Remember, these only need to be approximations. You don't need to know the exact figure at this stage. So, for example, you may forecast that in the first month you have $300 in equipment costs. Note that you should always provide a reference as to what the expense is. Although it's not mandatory, I also list whether a cost is fixed or variable as well. A fixed cost means an expense is more or less the same amount at regular intervals. A monthly lease repayment on a vehicle would be a fixed expense, as it's the same amount at the same time paid each month. As you can see, you add as many expenses as you think you'll have and forecast on what date you're likely to need to pay these expenses. You'll see at the bottom of the spreadsheet there'll be a total amount based on what you've forecast. If you return to the cash flow statement by selecting the tab at the bottom of Excel, you'll see for the month of January you'll have your opening balance. We haven't forecast any revenue yet, so there's no figure in there. We've just forecast $3,150 as expenses for January. So this means our earnings before interest and tax is minus $3,150. Earnings before interest and tax subtracts expenses from revenue for the month. This gives us an indication if we have made or lost money in that period. At this stage, we won't worry too much about interest and tax. This can be discussed later. So now our closing balance is $1,850. This is because we started with $5,000. We then spent $3,150 in January, and we now left with that figure as a closing balance. You'll also notice that the opening balance for February is the same as the closing balance for January. As mentioned, the opening balance will always be the same as the closing balance for the previous month. You'll see we haven't entered any forecasts in for the month of February, so the balance will not change until we do the forecast for that month. Okay, so let's have a look at the month of February. Again, we forecast expenses for the month, just as we did for January. Now back to our cash flow statement, we can see our opening balance is $1,850. We haven't forecast any revenue for this month, and we've spent $2,700. That makes earnings before interest and tax at minus $2,700. So if we subtract our earnings before interest and tax from our opening balance for February, we actually have minus $850 left as our balance. Obviously that's not great. So let's go back to the forecast for February. In reality, you should probably be adding more expenses as you tend to spend more as a startup business starts to operate. In this case, let's go and add some revenue in as well. Hopefully, not long after startup, you'll start to see revenue coming in to help balance out the cash flow situation. Now if we return to the cash flow forecasts, for the month of February you now have revenue in at $7,000. It's forecast the business will spend $4,150. Therefore, earnings before interest and tax is $2,850. That actually means the business would make a profit for that month. So if we add the opening balance to the earnings before interest and tax, then our closing balance will be $4,700. That's great because it's better than the closing balance for the previous month, and it shows the business is starting to make more money. Now what's interesting is that the closing balance is still not past the opening balance when the business first started. So although you made a profit for the month of February, you still haven't made an overall profit for the time the business has been operating. So let's go into March and enter forecast there. We'll have a total forecast for expenses. We'll also have a total forecast for revenue. Now in our cash flow forecast, you'll see the opening balance is $4,700. This is brought forward from the closing balance we had in February. As it's less than the $5,000 we started with, the business has still not reached break-even point. Now we have revenue of $5,000 for March and expenses of $4,250. This means the earnings before interest and tax are $750. This means our closing balance for the month is $5,450. This balance is carried forward as the opening balance into April. As you can see, the opening balance is larger than the amount of cash used to start the business in January. This means the business has reached break-even point. This video tutorial has shown you my approach to cash flow forecasting. There are many ways of forecasting break-even point depending on the type of business you're running. For example, you may calculate break-even simply by subtracting the cost of making an item from the price you get for selling an item. There's examples of these methods provided in the links for this topic. Thanks for taking the time to view this video tutorial. Remember to check out the resources, links and assessment tasks. Bye for now.